In 2023, the global attention is focused on the interest rate situation of the U.S. Federal Reserve. Interest rates are a critical factor that impacts the global economy because they are set by central banks and have far-reaching effects. Central banks use interest rates as a tool to stimulate or cool down the economy. The decision to lower or raise interest rates is made by central banks, not the market. When central banks lower interest rates, it can stimulate borrowing and spending, which can boost economic activity. Lower interest rates can make it cheaper for businesses and consumers to borrow money, encouraging them to invest, spend, and stimulate economic growth. Conversely, during times of high inflation, central banks may raise interest rates to cool down the economy and control inflation. Higher interest rates can make borrowing more expensive, which can reduce borrowing and spending, and thus slow down economic growth. Interest rates also have a significant impact on stock markets. When interest rates are low, it can make borrowing cheaper for businesses, leading to increased investment and potentially higher stock prices. Conversely, when interest rates rise, it can increase borrowing costs for businesses, leading to reduced investment and potentially lower stock prices. Interest rates can also affect exchange rates. Higher interest rates can attract foreign investment, which can lead to an increase in demand for a country's currency and potentially strengthen its exchange rate. Conversely, lower interest rates can lead to reduced demand for a country's currency and potentially weaken its exchange rate. In summary, interest rates are a critical tool used by central banks to influence borrowing, spending, investment, and economic growth. They have a significant impact on various aspects of the economy, including stock markets, exchange rates, and inflation. Therefore, understanding the concept of interest rates is essential in analyzing and predicting the behavior of economies and financial markets. Interest rate is a topic of great importance. It is commonly encountered in various aspects of life. For example, if the interest rate is 2%, and you deposit $100 in a bank this year, you will have $102 next year. If you borrow money from a bank, say $100 this year, you will need to repay $102 next year. Interest rate can be understood as the time cost of money, where $100 this year is equivalent to $102 next year. Why is interest rate so important? Let's simplify the question. Let's assume that in this economy, all interest rates are the same, whether it's for savings or loans, whether it's for Bencat or Musk. Regardless of whether you save for 1 year or 10 years, all interest rates are the same. Now, what would happen if I reduce the interest rate from 2% to 0% while keeping other conditions unchanged? In this economy, everyone holding money would think, there's no interest anyway, I might as well spend it on buying a house, a car, or a luxury bag, or invest in opening an online store or a restaurant. In other words, there would be a decrease in savings and an increase in consumption and investment. At the same time, people would think, loans are interest-free, I might as well borrow more. Companies would borrow more, expand production, hire more people, promote sales, and invest, and so on. Compared to when the interest rate was 2%, more people would borrow more, invest more, and consume more. Many people would borrow to buy houses, and the sellers would have more money to buy cars. Sellers of cars would have more money to buy luxury bags, and sellers of luxury bags would have more money to give to me. Sellers of luxury bags would buy houses, and sellers of houses would have more money again. The entire economy would be more active, creating a virtuous cycle. So, simply lowering the interest rate from 2% to 0% would make everyone start earning money, and people would work harder. Everyone's lives would become better. That's why central banks of various countries are well aware of this principle. When there's an economic issue, they immediately lower interest rates to stimulate the economy. For example, in 2020, when the Federal Reserve was preparing to raise interest rates, the pandemic hit, and they immediately lowered interest rates to stimulate the economy. Europe and Japan have been lowering interest rates for years, and they have been hovering around 0% for more than a decade. So, you can see that central banks have a challenging job. It's not just about lowering interest rates to stimulate the economy. This approach is certainly unreasonable. In the previous example, we discussed how lowering interest rates from 2% to 0% can stimulate economic activity, reduce unemployment, increase consumer spending, and ultimately lead to inflation. On the other hand, raising interest rates can initially tighten the economy, slow down inflation, and reduce consumer spending. However, in the long term, it can also lead to inflation. Let's take a look at some headlines in 2022. In May 2022, the Federal Reserve increased interest rates by 50 basis points. The European Central Bank plans to begin its first interest rate hike in July 2022. The Bank of England raised interest rates for the fourth time, reaching 1% with a 25 basis point increase. The People's Bank of China began lowering interest rates in 2022. As of 2023, some large banks have already experienced financial difficulties, but the Federal Reserve is still raising interest rates. The interest rate that the central bank controls is not the same as the deposit rates we usually see in banks for 1-year, 5-year, or 10-year terms. Let's take an example. If I want to borrow a 10-year mortgage from a bank at an interest rate of 5%, how does the bank arrive at this rate? Let's break it down. There are mainly three components. 1. Risk-free rate. Let's assume it's 3%. 2. Risk premium. Let's assume it's 1.8%. 2. This is based on factors such as my financial condition, income, collateral, etc. 2. The bank uses a series of complex models to determine the probability of me defaulting on the loan and the associated risk. 2. The higher the risk, the higher the risk premium. 3. Profit. This is the amount the bank wants to earn from the loan. 3. Let's assume it's 0.2%. When these components are added together, it becomes the 5% interest rate that you see. The actual interest rate depends on market competition and the bank's own situation. The risk premium is based on factors such as my financial condition, income, collateral, etc., and is calculated through a series of complex models. The lower the risk, the lower the risk premium. The remaining risk-free rate is the foundation for all interest rates in the market, including deposit rates, credit card rates, and mortgage rates. This is also the interest rate we commonly discuss. The term risk-free rate refers to the interest rate required by a borrower who is considered completely risk-free and certain to repay the loan. In real life, the closest to risk-free is the government, especially those of larger economies. The corresponding interest rates of government bonds, such as Chinese government bonds, US Treasury bonds, Japanese government bonds, and German government bonds, can be approximated as risk-free interest rates of the corresponding currencies. These government bonds are traded freely in the secondary market, and therefore have prices, from which we can deduce the interest rates. For example, if the price of a 10-year US Treasury bond for 2022 is 100.5312, we can calculate that the corresponding interest rate is 2.814%. Of course, how to calculate it is not necessary for you to know. This 2.814% is the risk-free interest rate for the 10-year US Treasury bond, or the risk-free interest rate for the US dollar for a 10-year period. So, for each currency and each time period, there is a corresponding risk-free interest rate, such as 30-year bond rate, 10-year bond rate, 5-year bond rate, 2-year bond rate, 1-year bond rate, 6-month bond rate, 3-month bond rate, and so on. We can plot these risk-free interest rates on a graph with time as the horizontal axis, and this will form a curve, which is called the yield curve, representing the benchmark of the economy. Usually, this curve slopes upward, indicating that long-term interest rates are higher than short-term interest rates. Sometimes, you may see an economy where medium and long-term interest rates are lower than short-term rates, such as when the 10-year bond rate is lower than the 2-year bond rate, which is called an inverted yield curve. This topic of yield curve inversion is a separate discussion and we won't go into detail on it today. But isn't it contradictory that we said earlier that the yield curve is derived from bond prices, which are determined by the market, while we also said that interest rates are controlled by central banks? Different central banks may have different approaches, but the general rule is that they all control short-term or relatively short-term interest rates. For example, the Federal Reserve, the Bank of England, and the European Central Bank all control the overnight borrowing rate, also known as the Fed funds rate, which is the most critical rate for banks. The central bank manages this rate. For example, after the 2008 financial crisis, the Federal Reserve kept the Fed funds rate between 0% and 0.25%. Recently, we have heard about various interest rate hikes, which are also related to this overnight rate. However, all other interest rates in the market are influenced through the government bond market or the mortgage-backed securities (MBS) market, and they are not directly controlled by the central bank. Although the central bank cannot directly control these interest rates, after the 2008 financial crisis, central banks realized that controlling only the Fed funds rate was not enough. When they were desperate, they started printing money themselves and participated in open market operations, such as buying 10-year or 30-year government bonds when they found that the interest rates were too high, or buying MBS when mortgage rates were high, in order to push down all long-term interest rates. This is what we often hear as quantitative easing, or QE in English. You can see, for example, the Bank of Japan, which is even more direct. They openly state that they will spend unlimited money to ensure that the 10-year government bond yield falls to 0.25%. Japan is doing this in order to achieve a slight inflation. They have been forced to take such extreme measures. If we look at loans, they are generally based on long-term interest rates such as 10-year, 20-year, or 30-year rates. So, in terms of direct impact, whether the central bank raises or lowers interest rates does not have a big impact on long-term interest rates. On the contrary, quantitative easing, QE, or tapering, which refers to reducing the scale of QE, have a significant impact on long-term interest rates. The key to economic activity is the circulation of money, and the core of money circulation is interest rates. The basis of interest rates is a risk-free yield curve. Central banks generally control short-term interest rates, while long-term interest rates are determined by market supply and demand. Central banks can try to influence long-term interest rates, but they cannot completely control them. So, the question is, what are the specific impacts of interest rates on our lives and the economy? If you understand the theories I just mentioned, you can deduce it yourself. Firstly, there is a relationship between interest rates and inflation. As we just mentioned, low long-term interest rates can lead to inflation. This is why when inflation is high in the United States, the market immediately expects the Federal Reserve to raise interest rates. And they don't raise it step by step, but rather raise it by 0.5% at once, instead of 0.25% each time. The goal is to timely suppress inflation. In April, the inflation rate in the United States was 8.3%, but the market expects that the average inflation rate over the next 5 years will be 3%. So the market is still quite calm about the Federal Reserve's approach of raising interest rates. Another example is Turkey, where inflation soared to 70% in 2022. One of the main reasons for this is that the president of Turkey believes that interest rates are the source of evil. Although there is internal inflation, he insists that it cannot be addressed through interest rate hikes, but rather through interest rate cuts. So, the relationship between interest rates and inflation is quite obvious. In addition to inflation, interest rates also have a direct relationship with bond prices. As we discussed earlier, long-term interest rates are derived from bond prices through reverse calculation. So, interest rates and bonds have a direct relationship. The identity in the equation for calculating bond prices states that when interest rates decrease, bond prices increase, and when interest rates increase, bond prices decrease. This relationship can be understood as follows. Let's say interest rates increase. The government will then issue bonds at a higher interest rate. As a result, the demand for existing bonds with lower interest rates will decrease relatively, and their prices will decrease. Therefore, the relationship between interest rates and prices for bonds of the same term is negative and consistent. However, the relationship is not as direct for bonds of different terms. As we just mentioned, interest rates form a curve, and the central bank controls short-term interest rates. What is more relevant to our daily lives are medium to long-term interest rates, which may range from 2 to 3 years to 20 to 30 years. Long-term interest rates can be seen as a combination of expected future short-term interest rates. Therefore, the increase in medium-term interest rates in the United States in 2022 is partly due to the Federal Reserve raising the Fed funds rate, the federal funds rate for overnight borrowing, and partly due to the expectation that the Federal Reserve Chairman will continue to raise interest rates to curb inflation. The relationship between interest rates and the stock market is not as clear-cut as that between inflation and bonds. When interest rates rise, it can have several effects on the stock market. Firstly, companies, both listed and small, may face higher costs when borrowing from banks or issuing bonds due to the increased interest rates. This means that their financing costs go up, which can hinder the growth and development. This can be seen as a negative factor for the stock market, especially for industries that heavily rely on financing. Companies with a significant portion of short-term debts on their balance sheets may be particularly impacted by the higher interest rates. Secondly, from the perspective of consumers, higher interest rates can also result in increased borrowing costs. This can affect consumer loans such as mortgages, car loans, and credit card loans, making it more difficult for people to borrow and reduce overall demand. This can also make it harder for companies to generate profits, as consumer spending may decrease. Industries such as real estate and automotive, which rely heavily on consumer loans, may be more adversely affected by higher interest rates compared to industries that produce essential goods. Additionally, From a valuation perspective, the stock price of a company is theoretically the present value of all its future cash flows, discounted at the discount rate, which is influenced by interest rates. If interest rates increase, the discount rate also increases, making the present value of future cash flows lower. This means that the future cash flows are worth less in today's dollars, which can impact the valuation of companies, especially those that rely heavily on future cash flows for their valuation, such as growth companies. While these factors may seem logical and reasonable, the actual impact of interest rate changes on the stock market is often minimal. Another factor to consider is the impact of interest rate hikes on market liquidity. When interest rates are raised, it typically tightens market liquidity as short-term funds become more scarce. This can be seen as a negative for the stock market, as it may result in decreased availability of capital for investment. However, this reasoning may seem simplistic, as there are multiple dimensions to the relationship between interest rates and the stock market, and the effects can be complex and intertwined. For example, as mentioned earlier, higher interest rates are generally considered unfavorable for the real estate market. However, interest rate hikes often occur during periods of inflation, as higher rates are used as a tool to curb inflation. During inflationary periods, many people may choose to invest in real estate as a hedge against inflation, which can be seen as a positive for the real estate market. This creates a contradiction, as the relationship is not always clear-cut. Looking at the past 30 years in the US and Europe, during periods of high interest rates, the real estate market has performed relatively well on average. The cause and effect relationships in economics are not necessarily difficult to understand, but the challenge lies in their complexity. Everything is interconnected, and interest rates are a significant tool for macroeconomic regulation, influencing the overall economy. However, when it comes to specific companies and individual stocks, there may be numerous factors that impact their performance beyond just interest rates. The impact of interest rates on an individual company or stock is akin to the moon's effect on the Earth. While the moon can influence tides and rotation, it is just one of many factors that determine how high an individual can jump. Let's go back to the topic. Generally speaking, when the central bank announces an interest rate hike, it is usually considered negative for the stock market. However, after 3 months, or even as short as 3 weeks or 1 week, it is hard to predict whether the stock market will go up or down. So it's not wise to rush into the stock market as soon as you hear about an interest rate cut. Of course, an interest rate hike can be positive for certain industries that deal with interest rates, such as banks or insurance companies, because banks make money from the interest rate spread. So if interest rates are very low, it is definitely not favorable for banks to make money. If you look at the historical relationship between bank stocks and the 10-year Treasury yield in the United States, you can see some positive correlation to some extent. We mentioned that the impact of interest rates on the stock market is not so direct, but another term we often hear is quantitative easing, which is different. The impact of quantitative easing on the stock market is more immediate. If you look at the past 10 years of quantitative easing in Europe, the United States, and Japan, you can clearly see the effect on the stock market. We can dig deeper into the topic of quantitative easing later. The impact of interest rates on the housing market is similar to that on the real estate market. Firstly, when interest rates rise, the cost of borrowing increases, which is negative for the housing market. However, as we just mentioned, high interest rates are usually associated with inflationary periods. If inflation persists and the stock market keeps falling, many people may invest their funds in real estate, which can be positive for the real estate market. So it's uncertain. Similar theories also apply to gold. High interest rates will increase bond yields and attract funds to sell gold and buy bonds. So theoretically, an interest rate hike should be negative for gold, as there has been a clear negative correlation between gold and government bonds in the past few decades. However, in an environment of inflation, especially in a US dollar inflation environment, people may buy gold as a hedge against inflation, which can be positive for gold. So it's uncertain. The impact of interest rates on exchange rates is complex and multifactorial. For example, if the Federal Reserve in the United States raises interest rates, it can lead to a higher return on investment for the US dollar, potentially resulting in upward pressure on the value of the US dollar. However, exchange rates are not solely determined by a single country's interest rates, but rather by the relative interest rates between countries. For instance, if the European Central Bank raises interest rates more aggressively than the Federal Reserve, the euro may experience more upward pressure relative to the US dollar, as the interest rate differential between the two currencies widens. This can result in the appreciation of the euro against the US dollar. Therefore, the interest rate differential, or the carry trade strategy, can be an important factor in analyzing exchange rate movements. Other factors that can influence exchange rates include inflation rates, trade balances, i.e., the difference between exports and imports, market sentiment, and intervention by governments and central banks, among others. These are some examples of how interest rates can impact exchange rates, but please note that this is a simplified overview, and actual market dynamics may be more complex. I hope this explanation helps you understand the relationship between interest rates and exchange rates. If you have any further questions, feel free to ask.